The notion that the precious metals have to go down with the stock market is not historically accurate. There have been a few times in the past 20 years where there was a point where the stock market dropped and so did gold. Gold, if it's technically vulnerable to have a correction, yes, but right now, no, it's not. It's ripe for an acceleration move. And I think that acceleration phase, which we've already entered in March, where gold started to really advance strongly, but it'll even do more so once that stock market starts to bleed and that money flows out. You get gold back up to 2,800 again, or even near the high. And we're looking now at Feb gold starting next week, February contract. It's about 2680 right now. And I'm gonna bet you silver's back to 35 pretty quickly. And when it is, I think at that point, you're gonna see that silver gold ratio change dramatically.
Since the turn of the century, the S&P 500 has seen real annual compounded returns of 4.9%, compared with 6.8% for gold. This is unique among the 9 quarter-century periods examined by Deutsche Bank. Gold has demonstrated a low and negative historical correlation to many financial indices over time, potentially helping to smooth out volatility and preserve wealth. For example, gold has shown a 0.01 and 0.09 monthly correlation to the S&P 500 index and Bloomberg U.S. Aggregate Bond Index, respectively, since the 1970s. A known name in technical research, MichaelOliver challenges the idea that gold always declines with equities, noting such instances are rare. Gold briefly fell during the 2008 financial crisis but rebounded to its highs by early 2009, while the S&P 500 took years to recover. Since running into $2,700 in October, gold prices have cooled off, consolidating below this mark, though still elevated compared to the last 12 months. Gold traders have joined the safe haven asset in pulling back, but if the past is precedent, one industry heavyweight could be ready to rally. While reflecting on the market, Oliver predicts gold is in an acceleration phase and expects its appeal to grow. Since March, gold, silver, and mining stocks like GDX ETF have surged on strong momentum metrics. Gold's liquidity may help with wealth preservation, providing investors with a relatively deep and liquid trading market that may be a key benefit of holding gold strategically. With a historical trading volume on par with major debt, currency, and equity markets, the estimated daily turnover of gold is more than $162 billion, equivalent to $41 trillion a year. Regarding gold's current pattern of 2 steps up, 1 step back, Oliver predicts a shift to faster gains, with 5 steps up, 1 back, as the stock market weakens. Similarly, silver is expected to advance more sharply from its current 3 up, 2 back trend. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The notion that the precious metals have to go down with the stock market is not historically accurate. There have been a few times in the past 20 years where there was a point where the stock market dropped and so did gold. But it's usually rare and isolated. For example, in 2008, 1 year into that bear market for the stock market, you're already 1 year off the high, well off the price high. Gold had been rising all that time. But in October of 2008, the stock market did do a crash event where it went down over 30% within a matter of a few weeks. It was October of 2008. Again, a year off the high. Gold joined in. But at that point, gold was technically vulnerable to have a correction. And for gold, that's all it was. It was like a 1-month event. And by early 2009, gold was back at its highs. Whereas it was till a couple of years later that the S&P could get back to its highs. Yeah. And gold continued up through too. So, but most of the time, that's not true. Gold, if it's technically vulnerable to have a correction, yes. But right now, no, it's not. It's ripe for an acceleration move. And I think that acceleration phase, which we've already entered in March, where gold started to really advance strongly. But it'll even do more so once that stock market starts to bleed and that money flows out and goes to a place that's behaving well. And you know, even some of the major banks and their analysts have said, hey, gold's behaving well. You know, it's going up. You know, reality has finally hit them. And, you know, it will hit them more once the public is hurt by the stock market decline. It's ever since March, remember from 2020 through early 2024, gold was in a range. Its maximum width was 20%. In fact, if you took off a couple months in 2022 when you had that plunge, it went down towards 1,600 gold. If you chop that out, it was really a 15% range. It was fairly trivial, you know, for a 3-year span. It finally broke through that stuff on momentum factors, annual momentum, quarterly momentum. Same is true with silver. Same is true with the gold miners. like GDX ETF and so forth. They all broke out via quarterly momentum and annual momentum and said, okay, we're tired of this 3-year baloney range. We're now awake again. The bull trend is reborn. And they shot up big. I mean, GDX, for example, went from 31 something to recently hit a high at 44. It's now about 38, okay? But it's still way off of the March breakout level. Silver was $25 to $26 when it broke out via our momentum metrics. Yeah, on a pullback now, it's about 31. Gold then broke out above 2,000, between 2,000 and 2,100 on our momentum metrics, and has recently hit 2,800. Now we're 2,660 as we speak. Okay, so well above that level. So it's already started to what you could call advance strongly, but it keeps having these pullbacks that everybody thinks is now the norm. In which gold goes up 2 steps, pulls back 1. 2 steps, pulls back 1. Everybody thinks that's now the new norm. And so all the technicians out there who were put to sleep or bored to death during the last 3 years, suddenly they have a new norm that's in play. It's a positive norm, but it's always going to correct. You could bet on it. And some of them say, oh, that was the top. Okay. Once that stock market starts to break and that money flow moves, then this advance in gold won't be 2 steps up, 1 back. Or for silver, it's been 3 steps up, 2 steps back.
Exactly.
You know? Yeah, it's the wild dog on a leash, but still it's an upward process. That norm, which broke the norms of the prior 3 years, okay, a much stronger set of norms, will change yet again into a more dynamic norm, where instead of 2 steps up, 1 back, it's going to be like 5 steps up, 1 back.
According to MichaelOliver, gold doubled from 2015 to 2020, while the Bloomberg Commodity Index lagged but later surged, doubling by early 2022. He anticipates a second leg up for commodities, aligning them with gold and creating investor opportunities. Gold and another precious metal, silver, notched a similar performance in 2024. The iShares Silver Trust posted a year-to-date return of 26.86%, while the SPDR Gold shares returned 26.84%. In both cases, those are the best yearly returns since 2020. Some of the silver's value is tied to its use in various industrial applications, such as solar panels, medical technology, and electronics. In times of economic recovery or when the supply of silver is constrained, it can outperform gold. For example, in 2020, silver outperformed gold by a wide margin as demand outstripped supply. Fundamentally, Oliver notes that major banks like Bank of America are bullish on silver, predicting 2025 will be its year. As demand rises, Oliver expects silver's price to surge, attracting more investor interest. Let's get back to the interview.
In 2020, gold had already doubled from its 2015 low, 1,050 to over 2,000. Okay. During that same time, the commodity complex by Bloomberg Commodity Index we're talking about declined from 2020, 2019, 18 to 2015. While gold had doubled, it had gone down. And in October of 2020, we put out a report saying commodity explosion. At that time, the Bloomberg was at 70. It went from 70 to 140 by early 2022. So in a matter of a year and a quarter or so, it doubled. And that still wasn't expensive for commodities. If you go back and look at 2008 on the Bloomberg, it was 230 or something. So even at 140, it's still cheap, historically speaking, to where it was in 2008. So it's been opposite to the stock market, basically. But no, we think the second leg up is about to begin. Because even if you look at the price chart of Bloomberg, since the war started in February 2022, that's when commodities basically peaked, 1 month later. So the argument that, well, you know, that was what caused commodities to go up is baloney. They'd already doubled by the time that war began. And since then, they corrected. But that correction really ended in late 2022, early 2023. And if you look at the price of the Bloomberg since 2023 or so, it's basically sideways, either side of 100. Right now we're trading about 98, 99. So it's totally boring, but it's well above, in fact, it was a 50% pullback to its bear low. And it's gone sideways. Well, our momentum studies indicate it's trying to turn up again and start a second leg. At that point, I think the Bloomberg will be in sync with gold. It's not always in sync, but this time I think it will be. And it will be a place to be if you're an investor. And the stocks that are related to the commodities, you know. Now, there's some major banks in the U.S. That have sort of gotten on the gold bandwagon recently. And I think it was BAC, Bank of America, that recently said 2025 is going to be silver's year. And I think they're right. Now they're late. We got bullish on silver, back in 2015 when it was $15, and then, et cetera, et cetera. And we re-entered again. We said, if you're not in, get in at 25, 26 back in March. Okay, yeah, it's pulled back some, but if you got in then, you're still well ahead. But it's got certain fundamentals that people in the industry are aware of, but most investors really aren't. And that is, it's an industrial metal too. So it has its own supply-demand problems. Particularly supply is fairly stable, not growing at all, whereas demand is growing, particularly among the Chinese, because the Chinese make, like 80-90% of the global solar panels, and the voltaic cells, and they need silver in each of those. And the rising price of silver doesn't really hurt the price of the solar panel, doesn't affect its marketability, even if silver went up. But the problem is the supply is not growing, and their demand is growing parabolically. And so, when you were a kid and I was a kid, silver industrial demand was photographs, it was in the film. Well, now it's gone, okay. But solar panels, which are, and you have to be green to understand this, in Africa and a lot of the developing part of the world, there are not the convenience of underground wires from a power station. You're out in the middle of the boondocks, and you've got a cell phone and things like that, but you don't have a constant power source. Therefore, mobile backyard power units are selling like hotcakes. And even in the U.S., I understand demand is off the page, particularly in Texas, where they get wiped out every year. The storms come in and they're down for 2 weeks, that type of thing. But solar panel growth is growing dramatically, and it's in double-digit percents annually. And so at some point, that's going to be an awareness button for investors. I argue that probably that won't be a provoking factor. It's underlying, but it'll become a public conversation once silver does shoot up big.
A complex set of economic data, market sentiment, and other leading indicators influences the precious metals market. For 2025, as gold continues to perform well, silver will likely experience a powerful resurgence, making it an attractive investment opportunity. Given MichaelOliver's insights on gold potential for growth, especially with their rising demand and momentum, is now the right time to invest in these precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.